26 centuries ago in Miletus in ancient Greece, a little girl asked the philosopher Thales what use there was in staring at the stars. He told her his observations suggested that the next olive harvest would be unusually good. So months before the season, he paid the owners of the local olive presses small deposits for the right to use them when the harvest came. If he was wrong, he lost the deposits. Irritating, but not fatal. He was right, though. The harvest was enormous. Every grower needed a press at once, and Thales controlled them. He named his price. Aristotle tells that story to show that philosophers can get rich if they really must, but the interesting part isn't that Thales predicted the harvest, it's how little he stood to lose if he hadn't. Let's draw Thales' deal. Along the bottom is the market price of hiring a press when the harvest arrives. Up the side is Thales' profit or loss. Three numbers matter. First, the market price. Hiring a press today costs 100 drachmas. Second, Thales' agreed price. That's also 100. Whatever happens before the harvest, he has the right but not the obligation to hire a press for that amount. And third, the premium. The right cost him 20 drachmas up front. That money is gone whether he uses the right or not. Now let the harvest fail. The presses sit idle and the market price falls to 70 drachmas. Thales still has the right to pay 100, but as an opportunity he sensibly declines. He lets the contract expire and loses the 20 drachma premium. Now let's push the market price down to 60 drachmas. The contract is still useless, but he still only loses 20 drachmas. That gives us the first half of the line. However low the market price falls, Thales' loss does not grow with it. 10, 60 or 70 drachmas, he still only loses 20. His maximum loss was fixed before the harvest began. Now go the other way. Once the market price rises above 100, the contract begins to acquire value. At 120, the right to pay 100 is worth 20. That repays the premium, so Thales breaks even. At 155, it's worth 55. His profit is 35. And at a market price of 200, the right to pay 100 is worth 100. Subtract the 20 he paid, and Thales makes 80 drachmas. So this is what Thales bought, an asymmetry. On the left, the worst result is known in advance. He can lose 20 drachmas and no more. On the right, there's no fixed limit to what he can make. A small certain cost, but an uncapped possible gain. The contract is what we now call an option, and its shape is what this episode is about. In the last episode, we introduced the story of Victor Niederhoffer, who sold insurance against market disasters. For years, the disasters didn't arrive, so he kept the premiums. Selling, though, required a buyer. Every umbrella coming off that belt went to somebody who paid a little each month for protection they mostly wouldn't need. One of those somebodies was Nassim Nicholas Taleb. Taleb knew Victor Niederhoffer well. In 1996, he visited Niederhoffer's Connecticut estate and came away impressed, which did not make him less suspicious. He kept returning to one question: how much of Niederhoffer's record was skill and how much was luck? A month before October 1997, they had dinner. Niederhoffer explained that he was selling naked puts, collecting a limited premium while accepting potentially enormous losses. History, he said, was on his side. History is often very reassuring right up until the point when it isn't. Draw the two positions and they are mirror images. Taleb paid a small fixed cost for open-ended upside. Niederhoffer took a small fixed gain with open-ended downside. The same basic trade viewed from opposite chairs. That's the outline. Now let's look under the hood. Suppose General Motors trades at $50. The right to sell it at $45 at any time over the next 3 months costs about $1. It's cheap because it will usually expire worthless. GM has to fall a long way quickly before the right becomes useful. Most of the time it doesn't, and the seller keeps the dollar. Now, GM falls to $35. The right to sell at $45 is suddenly worth at least $10. On the buyer's book, $1 paid, $10 received, a profit of $9. On the seller's, $1 received, $10 owed, a loss of $9. Taleb held contracts like this across hundreds of stocks. For a year, the trade looked excellent from the selling side. Premiums arrived month after month from people insuring themselves against something that obstinately refused to happen. Meanwhile, the market kept climbing. Every week it rose was another week the sellers appeared to be right. On October the 27th, 1997, the market fell 7% in a single day. The machine stopped, then ran backwards. Every premium Niederhoffer had collected went the other way, followed by everything behind it. In an afternoon, he lost the fund, the house, and the silverware. Taleb described the opposite position in 10 words. We cannot blow up, we can only bleed to death. The bleeding was deliberate. The aim was to remain alive until the unusual day eventually turned up. Let's leave finance aside for a second. Put 3 things through the same shocks. A wine glass is fragile. Small knocks damage it, and one large knock might finish the job. On the other hand, a stone is robust. The same shocks leave it more or less unchanged. They don't improve it, but stones have modest ambitions. The third responds differently. Here's the shock, an infection. Nearby cells detect it and send an alarm to the bloodstream. The vessel wall responds, and white blood cells pour into the tissue and overwhelm the invader. When the infection's gone, some remain as memory. Next time the response is faster and better prepared. The system hasn't just recovered, it's kept notes. Nothing here depended on predicting the shock. What mattered was the thing exposed to it. So let's draw the responses. Along the bottom is disorder, how hard the world shakes. Up the side is the result. The glass is damaged, it's fragile. The stone is unchanged, it's robust. And the immune system, well, it improves. Its curve bends the other way. We don't have a word for it yet, but keep the shape in mind. Look more closely at that third curve. Take equal steps of disorder. The first produces almost nothing, the next produces more. Each additional unit is worth more than the one before it. The payoff doesn't merely rise with disorder, it rises faster. That's the property that both Thales and Taleb bought. Except their payoffs were hockey stick. 2 straight lines with a corner, not a curve. Quite right. That was the payoff on the day the contracts expired. Suppose Thales wanted to sell his right before the harvest instead. Press hire currently costs 90 drachmas, below the 100 he agreed. Exercised today, his contract is worth nothing. But summer isn't over. The harvest could still be enormous. Nobody sensible would give that possibility away for free. Before expiry, the right still has a price. That price follows the curve rather than the stick. And a curve like this can turn movement itself into profit. Shake it evenly, 1 unit each way, and the rise pays more than the fall costs. That's got a name, convexity. Buying these contracts means losing money most of the time. Taleb's firm could bleed for months. That's the real cost of convexity, the premium and the patience. The eventual win must repay all of those small losses and then some more. Whether the strategy works depends on the price of those contracts, and those prices come from a formula, the Black-Scholes-Merton equation. In October 1997, Myron Scholes and Robert Merton received the Nobel Prize for their work on options pricing. Both were partners in long-term capital management. In its simplest form, the model assures that extreme market moves are vanishingly rare. Here are the daily returns since 1950 with the bell curve laid over them. The model says almost every day should fall within this range. The real market keeps producing days far outside of it. 27th of October sits beyond 7 standard deviations. Under the model, a day beyond 5 should appear roughly once every 7,000 years. In the real data, one appears around every 362 trading days. Use those odds to price crash insurance, and the insurance comes out far too cheap. 13 days after the prize was awarded, Niederhoffer was gone. Less than a year later, long-term capital management nearly followed. The Federal Reserve gathered the banks to arrange a private rescue. More worryingly, that formula still sits on the desk of every trader. If crash insurance can be bought too cheaply, why doesn't competition remove the opportunity? One answer comes from psychologists Kahneman and Tversky. Offer people a guaranteed $100 or a coin flip that pays $200 or nothing, and many people prefer the guarantee. Frame the same choice as a loss, a guaranteed loss of $100 or a coin flip between losing $200 and losing nothing, and many prefer the gamble. The expected values are identical, but our appetite for risk changes with the framing. We protect gains and we gamble to avoid accepting losses. That preference creates demand for smooth returns even when they conceal rare disasters. It also makes the steady cost of crash protection hard to tolerate. Niederhoffer's investors weren't fools. They wanted frequent evidence that the strategy was working. The market often rewards whoever can endure the opposite experience. Now return to the curve we left unnamed. Convexity is its mathematical property, but Taleb wanted a word for what possessing it does to a system. He called it antifragile. It doesn't mean tough or resilient. Tough things survive disorder, and antifragile exposure benefits when the world becomes more variable. Its payoff bends upwards. That's the idea this channel is named after. Empirica, the fund Taleb built to run this, never made spectacular money. It cost a little most months, for years. That was the design working. What it bought wasn't wealth, it was the certainty that no single day could end him. But that certainty is charged for, and not everyone can pay it. If protection costs you a little every year and may wait a decade to pay out, can an ordinary investor hold on? In the next episode, we'll examine Mark Spitznagel's answer. We'll test several safe havens against a quarter century of real data and see which ones actually reduce the risk without costing you the return. I'll see you there.